Perfect. Thank you very much, everyone. I hope everyone has settled down, found their seats, and helped themselves to the food at the back. So my name is Nicholas Amaya. I'll be helping to MC and keep the flow of things as we go today. We're all very excited, and we have an amazing set of panelists here next to me who can ultimately help you get a better understanding of how we can get ahead in this real estate market. So to get right into it, I'll briefly introduce all of our speakers. Third, we have Daniel Pacheco, who has been working for 12 years as a mortgage broker and is also a member of the Mortgage Professionals Canada. He is a business owner of the Mortgage Brothers Corporation and is also a real estate investor.
Hi, everyone. On behalf of my brother David, the entire Mortgage Brothers team and I, thank you very much for attending the conference and talk about mortgages in a volatile market. We all know that mortgages are quite different than before. Some policies, regulations, rates all over the place sometimes make us think, hey, is it still worth it to invest in real estate? So we had so many clients that they were ready to buy a property and they stopped because they may think that it's not a good time. However, we know that time of crisis bring new investors, new successful investors. So I understand that most of you guys are already investors, but we are going to talk about 3 topics today. The first one is about first-time buyers. You may know somebody that is looking for a property. It's always good to know what is going on for the first-time buyers market. We will talk about alternative lenders and private lenders. And in the end, I will present an example. The government recently launched this program, is the First Home Saving Account Plan. So it's pretty similar than the RSP plan. The main difference here is like the amount of money you save in this account and you use it for down payment doesn't require a repayment. So, and you can save $8,000 per year for a total of $40,000. Again, it doesn't require repayment. That's the advantage of this program, and you can save money in taxes when you file your income tax. So the RSP is being in place for several years. We all know that. You can withdraw up to $35,000 individually. I mean, if you are buying a couple, you can withdraw up to $70,000 if you both are first-time buyers, or you have not owned a property in the last 4 years. Now, the difference between this program and the previous one is pretty much that this program requires a repayment. So you will have up to 15 years to make that the repayment. Back to the RSP account. Now, the Waterloo Region program. So we can proudly say that we have helped so many clients buying their first home using this program. And many of them are investors now. So some of you guys have like 5, 10 properties and you started with this program. I understand that the situation is different, circumstances have changed, but the program still exists. So if you have any questions regarding this, we help you out actually with the entire process to filling out the paperwork, submitting the application to the region. Now we need to wait. It's not like before, like we got the funds right away. It may take like 6 months or 1 year sometimes. So, but in the end, if you are not buying now and you are planning to buy in the future, this program still exists. Okay, so for investors, most of us are investors. So we all know that banks, regular banks like A lenders, right? They have their policies more strict like other lenders, like B lenders or private lenders. Some of them allow us to have 4 rental property max. Some of them up to 5 exceptionally. 5 rental properties plus the owner occupied. But what about if we want to buy more properties, right? We need to use alternative solutions. And alternative lenders are getting more popular lately, especially with investors. I understand that we need to have 20% of down payment at least, and comes with a higher interest rate. But if the numbers work, so this program or this type of lender, are in place. We have so many clients, and myself even, that own a rental property through an alternative lender. For self-employed people, I'm a self-employed myself, so we know that when we file our taxes, we usually deduct so many business expenses, right? And in the end, our net income may not good enough to qualify for a mortgage. The government knows that, lenders know that, so they have created, alternative lenders, they have created a program to use bank statements, business bank statements and invoices to support your income. So there are clients like the net income in the last 2 years, the average of the last 2 year income was like $50,000. However, when we use bank statements, so we take a look on the entire gross income, deduct the expenses, and the net income could be sometimes 2 or 3 times. So let's say $100,000 will help for sure the client to qualify for a higher amount. Now, alternative lenders are also regulated. So it's not like I have 20%, then I can buy whatever I want through alternative lenders. So in those cases, when alternative lenders can't help us, private lenders are there to help us. So this year, we have closed several transactions through private financial institutions. And if the numbers make sense, so we will help you out in a spreadsheet to determine the cost. And if it's still worth it, we can go through a private financial institution for a temporary loan. Now, I understand that we don't want to stay with a private lender for, let's say, more than a year, right? Because the plan is maybe to convert or turn the property into a duplex or triplex, and then refinance the property and pay off the private lender. This example, we are currently working in the office. So most of you know that when you bought a property, you refinance one of your property to take out the down payment, right? However, we all know that we can have up to 80% of the property value in mortgage or mortgages. What about if we don't have equity to take out, like this example? And this is a real example that we are working in the office right now. Property value, $700,000. However, the current mortgage balance is about $600,000. Doing a simple math, does the client have enough equity to take out? 80% of 700,000 is 560,000, right? So there's no equity to take out. Now, the advantage of working with the right team, so let's say working with Eduardo, Humberto, our contractors, may help us to qualify for this type of mortgage. Why? Because we will take a look in the after renovation value. It's also called sweat equity. So we will ask our realtors or our appraisers, hey, how much is going to cost this property when the renovations or the conversion into a duplex is finished? So this example make us $875,000 for a legal duplex, nice duplex, obviously. And this is real. So our lenders, that they work with us, they will take a look in the final value, not the current value. So the final value. So $875,000 times 80%, it means that the client could have up to $700,000 in mortgage. So since the current mortgage value is $600,000, it means that the client can take out up to $100,000, finish the renovations. When the renovations are done, we refinance the property and pay off the private lender. I understand it comes with cost, right? In this example, if the client stays for a year, so the cost is going to be around $14,000. But look, the home appreciation. So the house has been appreciated in over $175,000. Less the cost, there is still equity that you are building up right away. So if you have any questions, my brother Dave and I will be ready to answer. Thank you very much for your attention.